welcome to the latest PMK virtual review. Today's edition, we are joined by Bennie Crous, co-portfolio manager of the PMK Fund of Funds, and in part two, we are joined by Stephen Hurwitz of 361 Asset Management. As we close out quarter one of 2023, uncertainty remains and a cautious approach is warranted. Risk management is a core mindset within all of our PMK solutions. To hear more, I'm going to hand over to Bennie. Thank you.
Thank you very much, Jared and Paul, for this opportunity to again present to your investors on the local portfolios. We live in exceptional times at the moment. I think 2022 taught us a lot of valuable lessons, which I will go into more detail as we go through the presentation. But if we look at what markets has done in December, or for the calendar year of 2022, we can really see that it was a bloodbath in the international markets. The only good news from the international perspective that we did have some buffering from the rand weakness, protecting us against the record-breaking sell-off in global asset classes. Why am I saying record-breaking? If you take an international global balance fund consisting of 40% bonds and 60% global equities, you actually need to go back 150 years to get a calendar year as bad as 2022. Now, one might ask, but what was so special about 2022? And many economists actually refer to 2022 as the Great Reset. I personally like to refer to it actually as the Great Normalization. If you take into account what has happened since the global financial crisis in 2008, and for the most of 2010s, global interest rates were running close to zero or even negative. And that was very much artificially propping up global markets. Now, a lot of that has reversed on the back of heightened inflation in 2022, which was exacerbated by the conflict between Russia and Ukraine. And that has caused inflation to almost rampantly run in the developed markets. That necessitated the central banks to raise interest rates, and that had a dire impact on markets, especially your global bond markets, which is very sensitive to long-term inflation expectations. Then you may ask the question, but why did South Africa fare a little bit better than what the rest of the world is? You know, our economy, we've got a lot of structural problems in our economy. Why would we have done so much better over 2022? And the reason for that is, firstly, as we went into 2022, our market was already very cheap. So there was very little scope for a drawdown in our market. But then we also had some tailwinds. We were one of the benefactors of, unfortunately, a huge humanitarian issue, but we were one of the benefactors of the Russian-Ukraine conflict because of the scarcity of resources. It propped up our resource sector of our market significantly. Then also in the last quarter, one can also see that very good performance coming through in the last quarter. That was mainly driven by Naspers and Process on the back of Tencent, on the back of the Chinese government foregoing their zero COVID policies. And then we suddenly saw a strong recovery in Chinese shares. South African property also had a difficult year, but a strong quarter coming through in the fourth quarter. That has really been driven by a massive sell-off in SA property for most of 2022. And that was on the back of rising interest rates, and that the market was expecting that property is going to struggle on the back of rising interest rates. However, with our engagement with a lot of our credible property managers in South Africa, many of our property REITs, listed property companies, actually hedged their exposure or hedged their interest rate risk by going into interest rate swaps. So they're not that exposed to rising interest rates. And in the final quarter of 2022, I think the market came to the realization that the market has overreacted and there's actually good value in the property sector. It does not mean that we don't have structural issues in property. The long-term impact from work from home, e-commerce, that is all very much risk overhangs in the property sector. However, given that rent collections has not deteriorated as expected by the market, and income distributions has remained higher than the market expected, that was very much supporting the good returns we got from property in the final quarter of 2022. Then the asset class which we were most excited about or the most bullish about was South African bonds. May not have given you the exciting returns that you got from SA property and SA equity. However, SA bonds was the asset class we were the most certain or the least variability around the expected returns. But SA bonds was not immune to the volatility of global bonds. It's also important to remember that US Treasuries are the first input in the valuation of any interest rate sensitive asset class. And with the volatility that we saw in US Treasury also spilling over to South Africa, but luckily we had enough yield in our bond market to protect us against negative returns. SA cash on the other side, I think it may be a little bit disappointing on the returns that cash has given us, especially if you look at what banks are currently offering on fixed deposits. But there's a very important caveat that I would like to point out here, and that is that our cash returns is backward looking. This was the average return you would have received from South African cash for the preceding 12 months. And please remember that there were periods in 2022 where interest rates was much lower. When banks price, for instance, for a fixed deposit, they actually look at the repo and the FRA and the yield curve as of today. And that is what they base their fixed deposit rates on. We've also investigated what is the forward-looking yield on the income, on the PMK income fund, and it's more or less the same as what you can get on a 5-year fixed deposit. This is now forward-looking yields. But huge difference between a 5-year fixed deposit and PMK income funder fund is that when the PMK income funder fund, you have 24-hour access to your money, whilst in a 5-year fixed deposit, you have no access to your money. But then we are almost 4 months into the new year, 2023, and how the world has changed in just 2 months. First of all, we saw a significant recovery in global markets, well supported by a weakening rand, and that was driving the majority of performance in your portfolios for the first 2 months of the year. Also, good credible returns coming out of South African asset classes, but unfortunately don't have the rand support backing South African asset classes, but still very credible returns coming out of South Africa. And the good returns actually started in October last year, and that was on the back that there was an expectation that inflation is under control and that interest rate hikes going forward will be more moderated. If we go to the performances of the PMK portfolios, the good news is this is as the end of February. All the performances now going forward, I'm talking about end of February. You will notice that over a 3-year period, all your portfolios are ahead of their respective benchmarks. And I would like to remind the investors, this still includes March 2020, which was one of the fastest and most severe sell-offs in history. It also includes the record-breaking global asset class sell-off that we had last year. Taking into account everything, I am pleased to tell you that over a 3-year period, all the PMK portfolios are ahead of their respective benchmarks. And that is a very comforting story. And it just again reinforces that you must remain with the plan that your advisor has developed with you. And one should stick with that plan because over time, given all this massive volatility we've seen over the last 3 years, we still managed to achieve the respective benchmarks of the portfolios. If we then go to what was driving the performance, this is more specifically over the last year, you can see that our strategic asset location, just maybe for everybody's benefit, strategic asset location is the purest passive execution of the PMK Balanced Funder Fund. And there's also a huge leap of faith in the return of the strategic asset location, and that is first of all, that it's possible to get indices that can 100% replicate the market indices. And it's also possible that you can get the market indices for free. But we know that is not the case. There is no tracker that can 100% replicate the market indices. And also, even though trackers are much cheaper than actively managed funds, there's still a cost attached to tracker funds. Then if we look from a tactical and a manager perspective, both tactical asset allocation and manager selection after fees have contributed handsomely to the performance of your portfolios. And on a tactical asset allocation perspective, the main driver has been that we were underweight global equities and global bonds, given that we saw the risk of heightened inflation and rising interest rates in the global space. And we maintained our overweight position to SA bonds and SA equities. And that has really driven the tactical asset allocation outperformance. Apologies for that. Also, what's important to this is that we have re-optimized the strategic asset allocations for all the PMK portfolios on the back of the increase in offshore allowance from Regulation 28, as announced by the Minister of Finance in February 2022. And we do believe in the long term, there is an investment case to hold more offshore. However, we were very prudent in the implementation of the new strategic asset allocation, and we very opportunistically traded onto the offshore exposure. The reason why I say that we need to hold more offshore going forward, barring all the structural issues we have in the South African economy, we also sit with the situation that the South African Stock Exchange is becoming more and more concentrated. So the investment opportunities is becoming limited in the South African perspective. So therefore, we do believe that in the long term, or through the fullness of time, we do believe we need to hold more offshore because the investment opportunities is so much big. There's so much more investment opportunities in the global space. Then also, I have to commend our managers that these are the people that execute on our portfolios, and in the sum of them, net of their own respective fees, they were able to contribute to performance. So if you look at the strategic asset allocation giving you 5.23%, through the active management process that we do as an investment committee at PMK, we were able to enhance the return by 1% net of fees over the 12 months preceding 28 February 2023. So I must say I am very pleased with these numbers, even though the numbers over the last 12 months was not as great as you may have become accustomed to as in 2021. It's still very credible performance given the turmoil we experience in the global space. If we just then look forward a little bit and look at what do we expect and where do we want to be invested, please, I just want to remind everyone that this is all done on a relative basis. So please don't take these views as an investment strategy. For instance, we are very bullish on South African bonds, but that doesn't mean you as an investor must be 100% invested in bonds because that may not be commensurate with your financial needs. But having said that, relative to all asset classes, let's first take local versus global. We still more preference to local because we do believe that South African local markets still offer great valuation opportunities. However, unfortunately, the biggest drawback from a South African perspective is that we have very much pressure on our economic growth, which does not support equities. But having said that, our companies in South Africa is extremely profitable, and can you believe it, at 80,000 points, the JSE is still offering good value. SA bonds is actually the asset class we're the most optimistic on. Maybe not going to give you the most exciting returns, but it's the place you're going to get inflation-beating returns with the most certainty. Of course, we can get better returns from SA property and SA equities. However, we also take risk or the variability of the return around the expectation into account. And we do believe that SA bonds is going to give you inflation-beating returns at the highest level of certainty or the least level of variability. Global side, we were for very long bearish on global bonds. It was one of the most expensive asset classes in the world. But we do believe that global bonds, after the significant sell-off that we experienced last year, is still offering good value, or is now offering good value. If you look at global equities, we're still very much cautious on global equities. And the reason for that is that the risk of a recession still exists in the global space. Recession mainly driven by heightened interest rates, and that potentially can cause a recession in the world. It's also important to understand the psychology behind global of equity investors versus bond investors. An equity investor is an internal optimist. They always believe tomorrow is going to be better. So what does it mean for the market? So typically, we see equity markets only bottom out when a recession is announced. And that is because equity investors just always hope that things will be better tomorrow. Then if you look at global bonds, typically a bond investor is an internal pessimist. They always fear the worst, and they typically start pricing in risks much sooner than an equity manager. That's why we believe that if there is a global recession, not only will the global bond market start pricing the recession in much sooner, but the global bonds is also going to be the asset class that benefits the most from a recession, because central banks typically starts to cut interest rates when we are in a recessionary environment. Global property, we were cautiously optimistic on global property, but our view has changed over the last quarter because global property will not be immune to recession, specifically sectors that are very cyclical, like office and retail. Those type of sectors may be exposed in a recessionary environment. Global cash, we've got a neutral view on that. You must remember that a big component on the returns of global cash is actually driven by the rand. However, given the volatility in the rand and that you actually can earn some return in global cash, we have a neutral view on global cash in the portfolios. Then just something I want to leave, a message I want to leave you with, and that is how emotions can destroy value in your portfolios. So I've put here two portfolios, and really this is not to play the one off against the other one. This is really just to show if you remain invested and stick with the plan that your advisor has developed for you, you will get the suitable return. So if you remain invested in the income portfolio and you've invested R1 at the beginning of January 2020, you would now have R1.20. If you've invested R1 in the worldwide growth portfolio, you would now at the end of February have R1.38. This does not mean the worldwide growth is better than the income portfolio. It just means that if you remain invested in the portfolios which is suitable for your financial needs, you will be rewarded. However, I have also done a hypothetical case where a person make investment decisions based on fear and greed. And this is the result that we get. So the same example, I still use the worldwide growth portfolio. If you remained invested through COVID, through the record sell-off that we had last year, at the end of February 2023, you would have R1.38. However, let's look at what a nervous investor would have done. So a nervous investor typically would have gotten out of the market at the end of March 2020, saying, I cannot afford any further losses. I want to get out. So basically realizing any losses that they have made up in that COVID period, gone to the income portfolio, remained in the income portfolio for the majority of 2021. Of course, 2021 was a phenomenal return, both locally and globally, and that could entice an investor to get back into the market. And then if you get back into the market at the end of 2021, you can see now you're taking the pain of 2022. And then again, at the end of September, this investor said, I've lost enough money, I'm going to get out. Just before the market turns, I'm going to go back to an income portfolio. So just look at that massive difference between returns. Instead of just remaining invested and sitting it out through all the turmoil, you would have had every R1 that you've invested in January 2020, you would have R1.38. But if your investment strategy is driven by greed and fear, that same R1 would only be worth 87 cents as at the end of February. I'd like to thank you very much for your time and all the best. I know that people would like to say, but things will get better. I do know there's still quite a bit of risk in the global space. Inflation is remaining stickingly high. But what I can say to you, and these numbers also show it, stay with your investment plan that is derived with your financial planner, and do not make investment decisions based on emotional fear or greed. Thank you very much for your time, and I wish everyone a very successful rest of 2023. Thank you very much.
Bennie, thank you for all of that detail. Only a couple of questions. The first one is you refer to value within the SA equity space. How do you differentiate between the dollar earnings type counters that account for 60 to 70% of the market and the SA Inc., such as banks and retail? Thank you.
Thank you, Jared. I do believe that is a very valid question or an observation that you have made. I think it's important that investors do recognize that a significant portion of South Africans' shares listed on the South African Stock Exchange is not generated or exposed to the economic welfare of South Africa. The one thing we need to take into account is that even though a lot of the returns or the earnings is generated offshore, the South African market is really earning a lot of that earnings in emerging markets instead of the developed markets. What does that mean? It means that the earnings that's made internationally is less exposed to the recessionary risks that we are seeing in the developed market. So that is the first question, the first answer, first leg of the answer, and that is to say that even though 60 to 70% of our earnings is driven by global economy, it is very much from other emerging markets in which our companies operate. So I do think the Rand hedge type of companies is not as exposed as a typical global equity market, because the majority of their earnings are generated in other emerging markets, of which China is most likely the biggest portion. Then from a valuation perspective, we definitely do see a massive amount of value in SA Inc., especially banks and the financial sector, and as well as the industrial sector. We do see significant value. Unfortunately, one of the risks of value is that something can remain cheap for a very long time. And value as an investment style needs patience. And we've seen this almost unexpected turn in the value cycle in November 2020 after the US election. And for the first time in almost more than a decade, value was a style that was outperforming all the other styles. So having said that, the SA Inc. side of South Africa is very cheap, but investors need to have patience. The side of our market where earnings is generated offshore in the global space, I do believe is not as exposed than a pure global equity component, because we are a significant portion of our earnings generated offshore comes from emerging markets. So thank you very much for that question, Jared. Maybe also just to add on to that is that one would also need to recognize is that the global equity or the global earnings exposure that we are getting through South Africa, that would typically not be a well-diversified earnings stream, because it's very concentrated in very specific sectors. These are typically resources, industrials, NASPERS, and process. So only using the offshore earnings capabilities of the South African Stock Exchange does not give you a well-diversified income stream. So it is very much exposed and concentrated to certain geographical regions across the world.
Bennie, for question 2 and 3, I'm going to link them together. The first one is, we've spoken quite a bit about the return profiles of our funds. How do we, or can you please elaborate on the risk management processes within our portfolios? And the third one is that with heightened inflation that we've experienced over the last 12 to 18 months, do we change our mindset or approach within our portfolios? Thank you.
Jared, first of all, from a risk perspective, we have many levers in our portfolios that we can pull on to manage risk in the portfolio. So our first defense against drawdown is our asset allocation. How much exposure we have to growth assets and how much exposure we have to defensive asset classes. I think it's very important to understand within the PMK portfolios, we have very deliberate risk measures in our portfolios where we don't want to put clients' money at risk in over and above an acceptable level of risk. And we refer to this colloquially to the value at risk number. So over any 12-month rolling period, we want to avoid returns in excess of that predetermined negative returns. So how do we do this? We do this through our strategic asset allocation. That is our first buffer against negative returns in our portfolios, or the appropriate negative returns in our portfolios. Then we also look at different investment strategies. So investment strategies, value, quality, momentum from an equity perspective. Quality typically is a more defensive investment strategy within our portfolios, while momentum is more trying to capture upside from the market. And value is that, almost want to call it that lucky packet strategy that works. And when it does work, you get a big, strong support from your returns from the value cycle that has turned. Then also the last component in managing risk, that is really our execution. This is where we use very credible managers in our portfolios. Some of them we rely on them to capture more upside in the market, and some of the managers we use in our portfolios, and this is specifically more pertinent to the bond space, which is typically seen as a more defensive asset class. We do use credible, flexible bond managers to manage that duration risk for us. So there's multiple layers of risk controls within the PMK fund of funds. Your question around inflation is quite a complicated question to answer, because one needs to understand what is driving inflation. Now, typically, inflation in the past was driven by strong economic growth, or also that the economy is becoming overheated. And in those instances where there's strong economic growth and inflation is driven by strong economic growth, you do want to have higher equity exposure, because typically equities perform well in a high inflationary environment, and you want to be underweight global bonds. Unfortunately, the situation in 2022 was not, or the inflation was not driven by high or strong economic growth. It was really driven by an oversupply of money in the system. Now, if we go back to the old classical definition of inflation, what drives inflation? And that is too much money chasing too little goods. That is the classical definition of inflation. So last year, the inflation number not driven by economic growth, but too much cash in the system. And in those instances, you really want to be positioned defensively across the board. And if you go back at 2022, especially from a global perspective, the only place you could really have gotten protection was to be in global cash. All other asset classes across the board has sold off. So if you're in an inflationary environment, which is not driven by strong economic growth, you really want to be as defensively positioned as possible as your mandate would allow, because that is the worst type of inflation that one can experience. This is inflation that's not driven by economic growth, but rather by an oversupply of cash in the system.